Okay. So last what we see is actually can you I'm just remembering the slides. Okay, very fastly. Okay, so we started about the question why investing. Okay, we have to consider the inflation, right? So because of considering the inflation, so there is a only option is we have to we no need to go for bank. Instead of that, we have for investing we have to go for this company. Okay, you can see the company they contributed more in the GDP. So the only way is we have to in GDP there are more big companies. They are the part of it. So we have to invest on these kind of companies. As I told you, there is a difference between that you are investing in a single company and as well as the mutual fund. Mutual fund means it's like a bucket of stocks. Okay, so that it will the risk will be reduced. I'm not saying there is no risk. In with the word investing, it means itself risk. If where there is a more risk, there will be you will get a more gain. Okay, but the point is compared to the separate company and this mutual fund as a little advantage because there is called diversification. So we diversified our investment into various company, not into one company. Okay, so that is what we discussed last time, right? So and now we have to come with one particular thing. Okay, so you can see this is a chart of I think 10 to 15 years. Okay, in why the people are not doing investing, can you please tell me why the people are afraid of investing? Anyone? Even though they know the investing, the people are not afraid, not they will not invest, they will go for bank only mostly. Why? Hello.
Yeah, for
Because
safety,
in private,
The meltdown.
security.
Fear of
See.
loss.
Correct. Fear of loss. Okay, then anything else?
Yeah, Pandya, can you make me the co-host and also move the yeah on your screen. You can move that.
Okay, sir.
Thank you. Yeah. So one of the important things is the meltdown that can happen in the stock market. One happened in 1930, and which most of us probably were not there. And the second one happened in 2008 when the stock markets crashed and many people lost their lifetimes investments and savings. So 2008 there was a meltdown because some of the markets, the stock markets, especially in the US, and then it had a ripple effect in the stock markets world over, and people lost everything.
Okay. Okay. Anything else? Anything else?
Yes, Pandit,
Yes.
I told, I said fear of loss. So personal experiences teaching us a lot. So after that, we are getting fear to deposit or give someone else.
Okay. Okay. Good. So I have this video. Okay, just see this video. Okay, this maybe this will help you. Okay. Let me know whether it is.
Will sir ask, raise the hand. Will sir open you.
Israel just struck Iran, 500 targets in one morning. While the world is watching the news, Jews are watching the stock market. Here's why. You see war and you panic.
Are you
We
able to
see
see the
war
screen?
and we calculate.
Yeah.
Israel
Is
just
it
struck
audible?
Iran, 500 targets in one morning.
Is it audible?
While the world is watching the news,
Okay, I'll put it in the start.
Israel just struck Iran. 500 targets in one
Audible.
morning.
Very much
While the
audible.
world is watching the news, Jews are watching the stock market. Here's why. You see war and you panic. We see war and we calculate. You hear bombs and you freeze. We hear bombs and we move. Not because we don't feel, because 3,000 years taught us that the man who freezes in a crisis is the man who loses everything in it. You sell your stocks when the market crashes. We buy. You pull your money out when the world gets scary. We put more in. You think that's cold. We think that's the difference between building wealth and watching it disappear. My father told me every crisis in history made two groups of people, those who ran from it and those who built from it. Guess which group is still here? You wait for the world to calm down before you act. We act while the world is still shaking. You call that opportunistic. We call it the reason Jewish families survived every war, every exile, every collapse, and came out stronger on the other side. The storm is here. Most people will hide. A few will build. The question is, which one are you? Comment build if you already know the answer. Save this. You'll need it again. Trust me.
Yeah, I hope you can you tell me what is the main idea they are telling? Can you anyone?
Vilas sir, over to you. You can start.
Yeah, the main idea is that here when the people are get panicking and running away and going for safety, that is the time is the real time of opportunity. When everybody is selling, we have to buy.
Yes, correct. Okay, right. So that is the idea, right? The people are who are usually panic, okay, and they will take a money. We don't want. Ma'am also said, okay, fear of loss. Okay, the point is the people who want to really build the wealth and they will put more money. Okay, the point is we need to have a good mindset. More than if I ask to build money, what do you need first? More than the money, you need a mindset first. Okay, that is what Ayyappan sir say, abundance mindset, abundant mindset. It means first you have to build the mindset. Without mindset, if you even you have a 10 rupees or 100 rupees, with that there is a possibility of building a wealth. But even you don't have that mindset, you have a 1 lakh rupees or a 1 crore rupees also, but you can't able to build it because the mindset is the first thing. Okay, right. So here you can see there is a ups and down. Okay, the people actually what in every Nara sir told. Okay, there are the particular point where you can see 50% down, 30% down, 80% down. But the point is the people are always think about in short term. Okay, short term, definitely you will, if you see the graph, you will get a heart attack. Okay, sometime it will go more and sometime it will go for so far. But the thing is, investing, according to me, this is for a long term. So your curve will be more smooth. Okay, for example, here, okay, I think, is it working? Okay, it is. Wait. Okay, it is not working. Very good. Okay, according to me, you have to see in the long term so that the curves also will be smoother. Okay, and the thing is in
Andya, please slow down. Please slow down. This is very, very important to grasp here. Can you go to the previous slide, or even that even the first graph? Yeah, previous one. This graph shows how the stock market has behaved over the last 25 years, from 1st of January 2000 to 1st of January 2025. And if we see the Nifty index, which was probably, looking at the graph, it was probably at around 2000 or 2000, roughly in 2000. it has grown up to almost the peak is around 27,000. So in 25 years, someone who invested, say, 1,000 rupees in any of the Nifty stocks, what is the percentage of growth that they would have experienced, say, from 2,000 to 27,000? How many times? So here there is this mention of Nifty 50 has delivered 11% per annum from Jan 2000 to March 2025. Even though there were so many ups and downs, as Pandya mentioned, over a period of time, it is not a short-term thing. If we enlarge this graph and see, that is what it looks like in the next one. Can you show that, Pandya? The next graph. So the short term will be like ripples like this, but when when it averages out, the curve that will look like is this. So that is what is explained in that graph. So at any particular short-term period, there can be huge growths and huge losses, but over a period of 25 years, it has yielded an average of 11% growth, which none of the banks can also give us interest, even in the fixed deposit. It will be now, it is roughly around between 6 and 7%. So it is almost double that people who invested and continued to stay in the investment could experience 11% growth, which almost like was from 2000 to 27,000. It is almost 20, 12 and a half times X. So X was invested, it became 12.5X. So that is the thing. Yes, over to you, Pandya.
Yeah.
And the table also
Thank you.
explains the same thing. Can you go to the previous slide, please?
Thank you, sir.
Yeah. So there was a 2000 there was a .com bust. So people were thinking that with the internet and other things, so the Y2K really proved the other way. A lot of people who invested in these companies lost heavy money. Almost 50% was the absolute decline. And even though in that period, Nifty 50 gave an yield of 13%, there was a growth of 13%. 2004, there, the Indian election was there. Again, there was uncertainty. The stock market dipped by 30%. In 2008, as I was mentioning, there was a global financial crisis. Every stock market crashed all over the world. There was almost 50%. I know people lost heavily, but still the Nifty grew by 10%. 2010, there was a European debt crisis. Again, stock market fell by 27%. But again, Nifty had a growth of 11%. In 2000, between 2020 and 23, COVID hit. And again, 38% downturn was there in the market. But Nifty grew almost highest as compared to the previous history. So if people did not get swayed by all these downturns, if they stayed invested, so their portfolio would have grown more than 10 times. So that is what Pandya has been sharing with us here. Yes, over to you, Pandya.
Yes, sir. Yeah. So here you can see the average of ups and down. Okay. So the thing is, if you see in the average, definitely for the long term, it will give you a very good thing. Okay. So, and one more thing is I want to tell you, first we need to know what is mean by SIP. Okay, for SIP, it means like a systematic investment plan. Okay, it is like you have, for example, you everyone will thought for investment we need a huge money. Okay, for example, when I heard about the investment also, I also think like, okay, oh, for investment we need 1 lakh, 5 lakhs, 3 lakhs. Okay, because in television also will be the same. Okay, the people in the movie, okay, movie also the one which gives a word investing. They also tell in many company, I invested 5 crore, 10 crore. No one tell even 100 rupees also you can use as an investment. Okay, no one tell. Okay, the why? Because we if we know about the SIP, even 100 rupees is enough. Okay, you can start investing. Okay, monthly 100 rupees, monthly 200 rupees. I'm telling you might think, hey, with 100 rupees, what you can do? Okay, I will give you a very good idea. Okay, so that you will understand. Okay, um, this is. I hope you can see this, right? Can you see this? So this is a chart created by me. Okay, I will explain you. This is very clearly. Okay, first thing is what is my goal? Okay, my goal is okay. This chart is very important. Okay, so my goal is 60. Okay, and I want 1 crore rupees. Okay, I put a annual rate of 12 percentage. Okay, so annual I'm getting averagely 12. Okay, I'm considering. See, this is a theoretical. Okay, in practical scenario, small changes will be there. Okay, this is to make you understand. You got it right? And you can see this area. This area is the age.
1 second, Pandya. 1 second, Pandya. Yeah, this is a very important chart, like Pandya mentioned. When he reaches he's currently 35 years old, and what he wants to achieve in terms of financial freedom when he reaches 60 years, right, Pandya? This is my
Yes.
understanding.
Yes,
And
sir.
he wants to have 1 crore as is the financial the value that he will achieve when he reaches 60 years old. So he's considering, like we saw in the Nifty 50, the average growth was around 11%. So here Pandya is a little more optimistic. So he's considered annual growth as 12%. Over to you, Pandya. You can explain that.
Yes. Okay. So here you can see this chart is the age. Okay, 4 age, 21 age. Okay, 18 age, 35, 60, like that. Okay, and this is like a monthly SIP. See, the point is, for 4 year old, my daughter, if she invested monthly 10, so monthly 100 rupees, she will reach at the age of 60. Okay, she will reach about 1 crore rupees. Okay, and if see, what is the total investment she did? I will tell you. Okay, the total investment she will did is, okay, if she invested 100 rupees, only 67,200 rupees only. Okay, for example, 60 minus 4, it is 56 years. So 56 years, she will able to invest only 6,000. Sorry, 67,200 only. But what is the output she will get? At the age of 60, she will get 1 crore rupees. Okay, that is what is all about us. Okay, you got it. Similarly, for example, my age is 35. Okay, my age is 30. My age is, sorry, 36. Now I have to investment do 6,000 rupees, so that my total investment is, it is like 17 lakhs 28,000, right? So 60 minus 34, it's around 14. It's around 24 age, right? 24. So after my 24, you can see here, this is 10th year, 11th year, 12, 13, 14, 15. After 24 year, okay, after 24, okay. So now you can see my graph. Wait, I'll show you.
Move the cursor.
Wait, sir. Here, I think this.
Do not select the row. You select only the the field, and then
Okay.
and moved up.
You can see at the 24th year. See at the 20. You can see here 24th. You can see approximately. I will get.
No, you got to
See,
go.
can you see the row? Can you see the rows? So rows is the where I achieve the 1 crore. Okay, the rows is the where I achieve 1 crore. When I will achieve at the age of 24. Can you see the 24? Okay, you can see in the left my age. You can see my left to my age, and you can see my monthly investment. Okay, green color is my monthly investment, and the white color is my total investment. The rows, wherever the rows is come, that is where you will achieve 1 crore rupees. Okay, the point is here, the point here is, if you, for example, my age is 35, okay, I missed 1 year, I missed. So next year I have to invest every month 500 rupees extra. I miss another 2 year. Then I have to do 2000 rupees monthly. Every month 2000 I have to invest. I invested, I forgot to start for 10 years. You see, after 45 years, okay, see, after 45 years, I have to invest instead of 5,000, every month I have to put 19,500 so that I will able to reach that 1 crore rupees. I hope you got this idea. Okay, you can see at the age of 15. Okay, so at the age of after 15 years only, they will get the 1 crore rupees. Okay, you got it. So the point is, if you delay or if you act, forget to start today. Okay, where tomorrow I will do or next month I will do. Every month the delay you have a money actually. Okay, every year delay. So as early as possible you have to start. I'm not telling, okay, see, I till now many people have afraid of not starting. I'm telling, no need to start for you. At least you have to start for your kid, because as I told, 100 rupees is enough for my child. Okay, if I started investing 100 rupees, okay, so you will get a habit. You think about the 21 day, 90 days. Okay, it will create a habit for your child. Okay, and this habit will definitely change her mindset, and they will see the world in different. Okay, that is what I want to say this. Okay, so this is a chart is very important, where it will and also see, if I get a 12 percentage, I told my age is 36, I have to invest 6,000 rupees. So at 24, at the after 24 years, I will get 1 crore, right? If I change this to 15, okay, this is theoretical only. Okay, if I change this to 15, see what happened. Okay, you can see all the changes is happen. Okay, all the changes happen, but the color is not there. Okay, wait, I will put a percentage because I have to put percentage. Okay, see, I put percentage. Now you see, I have to put 6,000 rupees. So when I will reach my goal at 1 crore is, you can see 21 years. Can you see this? Instead of 24 years, okay, 21 years. If you get maybe 20 percentage, then you will achieve your goal as early. Okay, so that is what. And one more thing is, I will not tell, okay, after 30 years, 40 years, you will get 20 percentage or 15 percentage. But what I can say is, there is a portfolio rebalancing. What do you mean by portfolio rebalancing is, you have to check your portfolio. If you started investing, you should not invest, you no need to care about the money. You have to take the money after 15 years, 20 years. That I won't accept this, because the market is changing. You have to find the opportunity, you have to rebalance your portfolio. Okay, take the money, shift into another pool. Okay, so that then only you can able to achieve for a long term 20 percentage, 25 percentage. Okay, so if you do rebalancing, you will get more better result than the normal one. Okay, so this rebalancing I will tell later. Okay, so this is the idea. And also some people will tell, but still now I not understand the mutual fund or investing. Then I will give you this idea, so that you will understand what do you mean by this. Okay, for example, You people well aware of banking, okay? You consider the scenario, I have 1 lakh rupees, okay? I'm considering annually I'm getting 5%, okay? In first year, I will get 5,000 rupees. Am I right?
Yes.
Okay. Now, on second year also, I will get 5,000. So it will add it to my principal. Third year also, I will get 5,000 added to my principal. So this is called simple interest. Everyone knows about it. Okay. And then you will ask how it will double. It will double at 21 years. How it will triple? Then it will triple on 41 years. Okay. So every 20 years, it will double, triple, it will do, because you see, I'm considering the scenario. This is not the real scenario. Okay. So considering scenario is 5% in every year. So you can see the double in 20 years. Another 20 years it will get another double. Another 20 years it will get another double. Okay. This is simple scenario. Then come to the mutual fund. Okay. What is mutual fund? Now you see, first year you will get 5,000 as a interest. Okay. Here also I'm considering in mutual fund. Now I'm considering 5% only interest. Okay. I'm not increasing to any, so that you will see the difference. Now the 5,000 will add it to the principal. Now you see the interest will change. Why? Because this is compound interest, means this principal amount added value also will get the advantage of interest. Okay. So that every time the interest will not be the same, it will increase. So that what will happen, instead of 21 years, you can see 14 years you are getting double the money. Then what about the next double? See, it is coming in 7 years. What will be the next double? It will come in 6 years, next double in 3 years, next double. You see, on next after 47 year, every year it is getting double. That is the power of compounding. Okay. And you might see, Pandian, still now I not understand how you can do it. So there is a formula. Okay. You can see there is called, for thumb formula is 72 for double, and there is a thumb formula is 144. So 72 divided by 5, or 72 divided by your interest. For example, you have a bank account. For example, I'll put like this. Then you can understand. For example, I put like I put like 6%. Can you tell me? Can you tell me your FD? What is the percentage you have right now? Anyone who have FD, you have RD? Can you tell me the percentage?
6.5%.
Okay, 6.5%. So I put like a 6.5%. 6.5. Okay, 6.5%. Okay. So what will be the answer? Okay, you can equal to
So basically what Pandya is explaining is how many years it will take for the money to double. So
yes,
72 divided by the interest rate will give the number of years
yes, sir.
it will take for the amount to double. So with 6.5% interest rate, if we keep it in FD, so 72 divided by 6.5, which will be roughly 12 years.
Yeah, 1 minute, sir.
Yeah, equals x2 divided by z2.
Yeah, 1 minute, sir. It's around 11.5 years. Okay, 11 years. Okay. So if 11 years, it will double the amount. Similarly, if you use the same thing for 114 divided by your interest, and it will give you the answer when it will triple your money. Okay, here you can see it will take 14 years to double. Okay. At the age of 14, you can see double, and when it will get triple at the 22 years. So you can see at 22 years, it is triple. So this is the very simple explanation. I'm not changing the principal amount. I'm not changing the interest. Then you will see the output. What is the difference? Okay. So instead of the bank, I'm talking about the long term, not the short term, not more than 3 years. Okay, if it is less than 3 years, my thing is I will if I will do go with the bank only, because less than 3 years I will go with the bank. That is a more safest way. Or else in mutual fund also we have a debt. Okay, so I will go with the debt if I want to do in mutual fund, or if I want to go in this, right. So this is what I want to share. So next class, I will tell what is SIP and how to do SIP. That and all I will see in the next class. Thank you.
Yeah, Pandya, one important point is about, you said the rebalancing of the portfolio. Yeah, it is not that, probably you can explain mutual fund and the SIP concept, how it will happen. The mutual fund managers, how do they take our money and invest, spread the risk over a variety of stocks, and how it will average out the risk aspect of it, and then what is
Yeah.
our role? What is our role in this thing? There was a time when production companies like Procter and Gamble, or those companies, their share value was increasing. Now the portfolio is changing in the sense that companies who are in the digital field, they're they are growing. The stock value is increasing in certain companies depending on this thing. So in the 1990s, probably it was manufacturing companies which were ruling the roost in the stock market. Now it is mostly information companies related to IT which are growing. So accordingly, we have to shift our investment from manufacturing companies to IT companies. So this is one simple way to explain. Thank you, Pandya. Thank you for
Yeah.
sharing the
Yeah,
compounding.
one was I forgot to say this three more slides, sir. Okay, that's it. This is a very simple explanation. Can I do, sir, just 3 to 4 that's it. The example.
Yeah.
Yeah. So the SIP is okay. Here you consider I want to buy a 50 lakhs of home right now. Okay. But what you have to do is the same thing. I want to do a SIP, but you have to consider with the inflation, it's going to be like a 1 crore. So what is your SIP? Monthly you have to make it 29,000. Okay. For 10 years, then only you can able to achieve. Similarly, for degree, your child may be 6 years, 8 years. Okay, but after 10 to 15 years, anyway, you have to think about the education, right? So higher education, if it is 20 lakhs, then you have to consider the inflation for 10 to 15 years. Now itself, you put a SIP. Okay, then only after 10 to 15 years, you can able to do it. Similarly, for wedding. Okay, wedding for each and every long term. Okay, wedding, education, home loan. Okay, whatever, you have to think what is the current price right now, consider the inflation, what is the time it takes, and then you can go with the monthly investment. Okay, and with the right instrument, you have to choose a very right instrument, then only you can able to do it, even for your retirement. Okay, what is your retirement right now you want, and if you have this particular amount, if you see everything will be done, then consider after some when you are at 60, then what is the inflation, what is the cost, then you do the SIP from right now. Okay, so this is the way it will work. So if you do SIP for every goal, you should create SIP, and you have to put it so that your life will be little more secure than the normal. That is what. Okay, sir. Thank you.
Thank you, Pandya. I think we should have feedback and reflection from everyone, whether they have understood the concept that you explained about the compounding, and how important it is to plan for returns which is higher than the inflation. So any investment that we do today, as we mentioned, if FD fetches us 6.5%, interest, but if the inflation is almost 6.5%, then it has a nullifying effect. So our investment doesn't grow, I mean, in terms of value. So the buying power will keep going down because of the inflation. And if we do not invest in a portfolio which is higher, which yields higher returns than the inflation, which is in most of the cases, if we keep it in a FD or in savings bank account, so our the money that we have kept there is losing actually in value. So this is what Pandya is highlighting. We need to consider inflation when we take into consideration any investment that we do, and the investment should yield better returns than the rate of inflation. Thank you, Pandya. Very, very powerful. Yeah, the table was very useful, and the graphs were also very useful. Thank you.
Yes, thank you, Pandya. So very, very powerful. It requires, like, since it's a finance, it requires understanding, and people have to come up with their ideas, what is there, if they're in what they have learned, and they want what they wanted to do, and this we need to inculcate in the kids' mind. That's more important. Now, what is more important is when we impart these things in our kids' mind. Now, that's why in olden days there used to be undial, no? See the cash box. So they used to put one coin, one day one coin, and maybe weekly one coin, like that. So it's a small savings, it's a small savings and a savings bank, So these things, when we, create that habit in our kids, it automatically happens. And for that to happen, we have to put that investment. That is what SIP. When we put that investment in SIP, people will also know, kids also will start seeing, and we will keep it in mind. And then education, that's the reason why people think that financial education is required only after completing degrees and then starting the job and then do the financial education. No. Financial education is a part of the education which is required in every curriculum. Okay, thank you, Pandya, for bringing out the beautiful. Now it requires a lot of understanding. It requires a lot of time. Now we people have to get. Thank you once again.
How much are you investing in your daughter's name, Pandya? You're muted. Please unmute.
Yeah, I'm doing, see, what I'm doing is whenever the salary come, I will sit with my daughter. Okay. I ask her to put a number. Okay. 3,000. Okay. She will put okay. And it is like a habit. I want to make her, it should be a habit. So she will do, she don't know what, she will do 100 enter. She knows the button, what to do. I do 3 times, 4th time she itself doing. Okay. Only thing is I want to do the password. I don't want to make it into automatic because it should be her remind in her mind. Okay, that is what my understand. And she has one box. I hope she has a box. I think it is here. Yeah. See, I think she has this. I bought her for this actually. Okay, if you so she has a key also. She put the key in as a dollar because someone will take the money like that. She put as a dollar. I said, why you put as a dollar? You will take my money, no? Like that. She has a key also. Okay, so she's a 6-year-old, 5-year-old now. 6 years next after 2 months she will be 6 years. Okay, so and one more better thing is when I used to talk to my wife. Okay, Amma, today we don't want to go out. Okay, I don't have money. Suddenly she come and take the money. I have money. Let's go, like that. I said, what? Let's go. You want money? No, I have money. I have more money. Come, let's go. Hey, Papa, it is. You should not take like that. See, actually, I am talking to my wife, not to her. But she listened to that, and sometimes she said, for example, I talk about after 2 years we will buy a bike. I said I no money. Suddenly she came up with this. See, I have 100 rupees. Buy bike tomorrow. I said, Papa, 100 rupees we can't buy. Why? See, 100 money is there. Then we can buy the bike. Come, let's have a bike. So the thing is, she is understanding something. I don't know, but I want to make her as a habit, and she is doing. Okay, and that is what I am doing with my daughter.
Thank you, Pandya. Thank you. Yes, I highly appreciate you sharing this. Purposely, I asked this question, and yeah, it is the responsibility of every parent to inculcate the saving and investing habits right from young age, like Ayappan sir said. Unfortunately, it is not there in any education curriculum, and yeah, most of us realize it's after a very long time that we have lost precious time. So currently, in this book, Psychology of Money, I think I mentioned this. Warren Buffett earned almost $81 billion after he had invested in for almost 65 years. So before that, it was around 3 billion, but because of the compounding effect, I mean, his total investment was 3 billion. Because of the compounding effect, it went up to $84.5 billion in a span of 65 years. He started investing when he was 10 years old. So that is, and he did not, of course, as Pandya mentioned, there was balancing of the portfolio depending on which stocks were going up and which industry, so to say. So he shifted, he sold certain stocks and then bought certain other stocks which were growing. All those things are definitely there. But staying invested, it is not that we get upset by the stock market performance and we keep selling and buying, which will impact the compounding effect adversely. So staying invested is very, very important. Yeah, that is a takeaway.
Yeah, sir. This is a very good idea. Okay, see this particular website. Okay, ET Money. You will see the orange color and you will see the blue color. Okay, in the orange color, it show how difference between first 10 years and the last 2 years. Can you see that? Because I told investment will grow if it is more money, more years. Okay, less money, more years. Okay, you can able to. For example, if it is 30 year. Okay, see for example, if I put 30 years. Okay, you can see the last graph. Okay, last two graph, and you see the first 10 year. So the thing is, first 10 year you won't see any growth. Okay, you will be frustrated. That is what the psychology is all about. Okay, first 10 to 15 years. Okay, it is very difficult that you will see the real growth. The real growth will be on the long term. The last 2 to 3 years, you can see this orange color how much double or triple the amount you are getting. Okay, that is what is all about. Okay, so the thing is, this will give you a pakka visualization. Okay, how sir told na last three on the 65 years. Okay, if you see for example, if I put a 50 years, you see the graph. 20 years there is no growth. You can see first 22 years there is no growth. You can see last 5 years how much growth it has. This is completely a compound effect. Okay, so that is what he has grown so much. Okay, so this is one of the very good website, etmoney.com. From that, if you go for SIP calculator, you will able to understand this. Thank you.
Thank you, Pandya. Yeah, there is also this corollary that we can learn from. How many of you know how many years it takes for a bamboo let me share the screen. Yeah. A Chinese bamboo tree story is a powerful metaphor for patience and persistence. These are the two attributes that every investor requires, in order to achieve that financial freedom. Where a seed planted, watered, and nurtured shows no visible growth for 4 years. Here, like Pandya mentioned, we don't see big nor or uh, visible growth up to say 8 to 10 years. Same way, a bamboo seed which is planted, or a bamboo shoot, if I can put it that way, it it will not show any visible growth up to 4 years. In the fifth year, it suddenly grows 80 to 90 feet tall in just 6 weeks. This rapid growth is possible because the plant spends the first 4 years building a massive, extensive root system to support its future rapid growth. So the same thing applies to our investment also. So key lessons from the story: invisible growth. Just because you cannot see results does not mean progress is not happening. You may be building your roots. Persistence. Giving up too early in the first 4 years would mean bamboo never grows. Preparation. The foundation you build during challenging times is essential to support future success. So, long term success, true. Lasting growth often requires long term effort rather than instant gratification. So, the story is frequently used to illustrate that success in life, business, or personal development often requires immense unseen work before explosive visible results occur. Yes, Vilas sir, please go ahead.
Wonderful, Pandyan. This Excel and all this, uh, as we know, the uh,
Vilas sir,
compounding
if you can
return.
please come on video, it would be helpful. It would be more impactful, Vilas sir.
Yeah, it's actually it's a my internet is big disturb because of the geopolitical situation. I'm in Dubai, so
Oh,
that's the reason. Yeah, yeah.
okay.
So the range is less. So the okay, coming to the point, compounding is the eighth wonder of the world, where the longest the period, the more the returns you will get at the end of the years, not initial years. So that is the one thing. Second thing, in SIP, dollar cost or rupee cost averaging is very important. Like rather than timing the market, you should be spend the time in the market. So longer the period in the time you spend in the market, that will give the vintage. And rather than putting the money lump sum, like nobody can uh, confidently say this is the lowest point to invest or this is the highest point. So rather than that, SIP will work in your favor. Month on month basis, you are keep on buying. If the markets goes down, you buy more units. So the number of units are more, although value is less. But over a period of time, same units value will increase. So that's way you will make money. So that's way rupee cost averaging is happening over a period of time in systematic investment plan versus a lump sum investment. So one is the habit to keep aside certain money, whether it is 100,000, 10,000, depending on the disposable income. But apart from that, we should put one objective why we are saving. Because if there is no why or objective, people most of the time withdraw the money when they want to buy any temptation, like buying a car or bike, or they want to buy a real estate or plot. They, rather than the portfolio goes for 5, 10, 15, 20 years, where we can see the magic of compounding. People immediately withdrew the money and put into down payment of the real estate and take loan, or they can buy something. So investment, each and every investment, you should have objective, like your daughter's higher education. This money will go for 20 years. For your retirement, this money will go for 30 years. Then only you can achieve long-term compounding growth in certain portfolios. Otherwise, without objective saving, will people get tempted to withdraw and spend somewhere else wherever they see greed factor. So that is very important area of discipline, why you are investing and for what you are investing and how long you are investing. So these are the three important areas in systematic investment, and in mutual fund category also there are 50 plus asset management companies, and India almost 1113 schemes. So it's very difficult for layman language which scheme to purchase, because each and every asset management company is having same type of funds like Tata Digital Fund or Tata Technology Fund, Reliance Technology Fund, HDFC. So there are different asset management companies. So we have to look at the AMC, their research team, the fund manager who is managing the funds and choosing the stocks on behalf of the pool of the money. So these are the important criteria. So rather than going for the only past performance of the scheme, we have to look at the holistic point of view, as at what risk, how much returns the fund manager is delivering. So these are the important criteria while selecting the funds. And rebalancing, ideally it is not happening once you select one certain fund, like you know that digital is the or technology is the idea, then you can keep on investing for next 10 12, 15 years without rebalancing, because in rebalancing we might go wrong. But SIPs will work, or you can put a objective like I need 15% or 20% is my requirement. So once the portfolio reach 20% of the value, then you can put take the profit and buy a different asset class like a gold or anything as such, which will like if markets are going down, at least other assets will save your capital. So these are the few strategies where you can work as a layman, that what is your tipping point, like 20% or 15% or 25%. Once you reach to that level, rather than expecting that it will go to 35%, you have to select that and do rebalancing. So that is the whole idea of rebalancing, that from where you started and where you reach, but be in the investment rather than withdrawing the profits and spending somewhere. So that is the whole idea of investment. What I uh, uh, what I'm doing from last 20 years and managing more than 35 million US dollars portfolio for almost 200 to 300 families here in Dubai internationally. So there are so many things in that, but my majority portfolio is in the mutual funds, index funds, ETFs, and all. So I do a lump sum as well as regular SIPs, and over a period of time, people grew their money like anything. Thank you.
Thank you,
Okay,
Mr. Miller.
thanks.
Thank you for sharing. Yeah, thank you about highlighting about rebalancing the portfolio. Yeah, it is very important. I think to begin with, especially amongst youngsters and this thing, probably what you shared is a little. It's although important, probably getting people into the habit of saving and investing is, I think, the first threshold that one should cross, and after that, it is it becomes easy. So I think that's where Pandya was focusing, and yeah, it's very important to start early and let the time and the compounding effect show its real power. Thank you, Mr. Vilas. Yes, I have a valid concept.
Okay. Good morning, all. Today we have a good session. I appreciate Pandirajan for giving us so much information. He has taken much pain for taking that slides, etc. It's a very good eye opener. One thing I found it that he is participate making children to participate in the family monetary affairs. That is a very good thing. That is so that in the younger period also, people, the children will get some knowledge about the financial management. That will be very useful in their future. So everybody knows about it, but in practical, nobody is following the system. I appreciate Pandirajan. Okay. Another Vilas sir also given us a very good information. So I think even there are so many funds, etc. We should watch the financial system, the mutual fund, etc. in around us, and we should take our own system of investing and see that our investment is growing. You can use so many things, even from the bank fixed deposit, share market, so many things. As Sasar told, when there is a dip in the share market, we can invest. I think when there is a crash in the market, we can close the fixed deposit and invest in the good shares. But for that, we require some suggestions from people who knows about the share market. Okay, anyway, the session is very good. Thank you all. Thank you, Sir also.
Thank you, Vilapan sir. Yeah, it's almost 7:30 now. Anyone who would like to share or reflect, you can please unmute and share before we can end the session. Thank you. So next week also you'll be continuing the session, right, Pandya?
Yes, sir. Yes, sir.
Yeah, great.
Very good.
Thank you. Great effort and yeah, the Excel and the graphs really helped in explaining and understand. Thank you. So anyone who would like to share anything or reflect on today's presentation by Pandya, please unmute and share.
So since today is Women's Day, I suggest that women earlier, they are just seeing the kitchen affairs only. They are not interested in the financial affairs. So that nowadays they have come up. They can also involve in the financial management of the family and give support to the male person also. Okay.
Yeah. The parents should let the children handle the household expenses. If they can be given that responsibility to manage the household expenses, giving them the money, and then they will know what are all the things that where money is going, and what they can do to save a part of it, a percentage of it. So that can also help. So giving them the responsibility to manage the household expenses early can also help them in the long term. Thank you, Velapan sir. Thank you for the service.
As Prasad sir told in the beginning, the mindset is one of the very important aspects. Even though we know almost every people, the majority of people attending the session is knowing about this compounding and so many things, but they are not having, many of them, as a general, I am not pinpointing anybody, we should also have the mindset to act as per the circumstances wanting. Okay, thank you, sir.
Sir, good morning, sir. Actually, I was investing in SAP and housing, but whenever there's huge investment, like I took a site, then I started constructing my house, then I started my hospital. So all my savings, everything was withdrawn at that time. Now my hospital itself is my passive income, active income, and old age pension plan. Everything depends on hospital only. So I don't know whether I've done right or wrong, but instead of taking the loan, I have taken it from my savings. But this is what is happening in most of our doctors' friends also. So just we won't be keeping long term. Maybe we should have kept long term. But I don't know. But that money we have utilized for positive things only. And most of us, it happens similarly. I think whenever we want to purchase some site or car, something, whatever we have invested in market, we would like to withdraw. It's right move, and what else people like me can do? Anybody can just suggest me, please. Thank you.
Thank you, Dr. Murli. Yeah, one thing is today's X, the buying power of X amount will go down after some time. Like you
Yes.
mentioned, you invest in your hospital, what are all the investments you had made? You took it, and probably the balance only you took the loan.
Yes, sir. Correct.
Uh,
Absolutely correct. Yeah.
This particular thing, you interrupted the compounding effect of
Yeah, sure.
the investment that you had made.
Correct.
According to Robert Kiyosaki, or even if we take Ambani or Adani, even though they have the money to invest from their own funds,
Mm.
they don't do that. They take loans.
Okay.
So I think there is one this thing about how the loan, initially, yes, the most of the repayment goes to the interest, but
Yeah.
slowly the amount that we pay starts reducing, and with the inflation, if it's an EMI, the amount stays, and it is the reducing balance basically that we'll be paying.
Yeah.
Whereas when it comes to investment, it goes in the compounding way.
Mm.
So
Yes.
So this is something that we all think, oh, why should I pay so much interest? So I have some savings. Let me pay back or close the loan early. So that will be
Yes,
a
sir. Yes, sir.
wrong thing to do. This is
Oh, okay.
that this is from my perspective. Maybe others.
Correct. So most of us will think like that. Whenever we have some money, we think of closing our loans so that see, because of what was my thinking, my mindset was that, see, I'm paying 8.5% loan interest. So if I invest in market, I may get 1 or 2% extra in that. And that's a risky money. I may get, I may not get, and whole investment go lost. Instead of that, if I put it back into my loan account, and there's 100% sure that 8.5% is reduced. That's what was my way of analyzing, my way of thinking. So
No,
anybody can,
there
yeah.
are two forces that are acting simultaneously.
Mm.
One is inflation, and the
Yes.
second thing is the growth potential because of the compounding.
Yeah.
In your loan, this thing 8.5%, that remains the same. And after some time, it becomes, once the interest part is paid, your principal starts coming down.
Yes.
EMI will go against your principal.
Yes.
So the net impact is, very less. And again, if it's a long-term loan, then the buying power of that EMI will keep going down.
Mm.
Whereas on the other side, the investment will be growing. Even in this thing, average long-term investment will average around 12%. So even that 8.5%, could have been offset if you had retained that investment. And after some time, it would even grow further, and you would still have the money with you.
Yes, sir. But
That
inflation part and
yeah,
compound interest would have been benefited.
suppose
Yeah.
you had 1 crore loan and you had say 50 lakhs savings, so you you paid that 50 lakhs and so that the interest burden would come down, whereas you
Yes.
did not analyze the real potential this 50 lakhs had over a long term. Over the same term of this thing, on one side you would be paying the EMI, so on the other side, this 50 lakhs would be earning, in a compounding way. And after some time, it will nullify, and probably, even this 1 crore loan, would be paid back if you continued with that 50 lakh investment. Maybe after 15 or 20 years, this loan would be totally become nullified.
Absolutely, sir. That inflation part and component interest I never thought of. Thank you so much. Yes, very nice. Thank you. Thank you.
Yeah.
And whatever the money I've invested in, so people will talk of passive income, then retirement plan, then plan for that, these and all those things. So people like me, for doctors, we have invested everything in our, anybody for that matter, most of us have invested everything in our hospital only. The passive income, suppose some doctor comes and sees the case, whatever the other part comes from, so it will be our passive income. Active income, of course, we go and work. And old age is like once the hospital gets established, some other consultants will work and they will hunt for us, and it will become asset for us for my daughter and all those things. That's what we doctors keep thinking. Is this the right way of thinking or something else we have to think, sir?
No, it has to be considered separate. Loan is different and investment is different, not to
Yes.
mix.
Yeah. Yes, sir. Got it. Yeah.
Thank you, Dr. Murli. Thank you for asking this question. Yes, Pandya. Then, I have a full-day session to attend, so I'll be dropping off. Anyone?
Yeah. Okay. Okay, sir. Okay, thank you. Yeah, so here we have a Veera sir, okay, Prasad sir, and Villa sir is there, okay. So I think they will help us in this. But according to me, you're talking about the loans, you're talking about the investment. Okay, the Villa sir is asking, we need a why. Why is very important in investment. So we should be very strong in why. For example, we are starting an investment. So we should have a strong why, and we should not touch that. That is a main important thing. And second thing is we should have an emergency fund for whatever the things we have. So for where anything happen, we have to take from emergency fund only. So we have to, again, after taking, we have to fill the emergency fund as soon as possible, so that it will be okay. That is the second thing. And third thing is, you talk about the loan and you talk about the investment. So I have one idea, but it's
Yeah.
everything is theoretically. I'll share it in the screen so that you'll
Yes,
understand.
yes, yeah. Because most of the tendency is to close the loan earlier so that the
Yeah,
burden will be less. Yeah.
sir.
That's
Here,
our mindset.
here you can see the. I think you can see the screen. I think I shared this already. Okay. So here you can, I think I shared this already. For example, you consider, I consider in this case is a home loan. Okay, 50 lakhs. You think 8% of the home loan. Okay. So it will take around 240 months to 240 months to fill the complete the loan. Okay. So the point is, you are paying a loan of you are taking a loan of 50 lakhs, and over this period you will 20 years, over this 20 years the loan amount is get double. It means you are paying another 50 lakhs of interest. Okay, so the point is, we want to get the 50 lakhs back. So for that, what we can do here, there is a formula is, take 2%. For example, if you are taking if you are ready to pay every month 41,000, take 2% of the month. Okay, 2% means it is a 5,000 rupees. If you put this 5,000 rupees in SIP, okay, if you put a 5,000 in SIP, after 20, this is 15 years, after 20 years you will get a and 12% interest, you will get the 50 lakhs. It means you are getting the interest back. Okay, I hope you can understood this. Okay, so this is
Can you just repeat once again, Punya sir? Please repeat it once again. I got it, but repeat it once
see
again.
the point is 50 lakhs you are taking an interest. So 50
Yeah.
lakhs you are taking a loan. 8% interest every month you are paying 41,000 rupees approximately. Okay.
Okay. Okay.
So you are paying 41,000 rupees for whole 20 years. Okay.
Yes.
At the
Yes.
at the end of the day, if you are paying 41 rupees for 20 years, you will pay nearly double the amount. It means 50 lakhs you
Yeah.
taken the loan and 50 lakhs is the interest. Okay.
Correct. Correct. Correct.
But the point is here I am telling you have to take this 41,000 regular in from the 41,000 you take 2%. Okay. Or more percentage, minimum 2%. 2% means it is a 5,000 rupees. So now you have to get a 46,000. Okay. Every month you should have 46,000. 41,000 you have to pay a loan and 5,000 you have to pay the SIP. Okay. So what will happen after 20 years because of SIP, you will get 50 lakhs back. You got it. So you because the maturity will come that back. Okay, that is also based on the interest only. Here I have given interest of 12%. Okay, but if this is everything is theoretically, but we have to do some work on it so that you will get approximately. The idea is whenever I am taking a loan, okay, I have to add another 3 to 4% of my loan. So that 3 to 4% I will make it as a SIP for I'm talking about long term, more than 15 years. Okay. So I will get back my interest also. So I'm that is what I'm planning to say. So this is one idea that I have. Okay. So maybe this will help you.
Yeah, Pandya, can you please do one calculation? What the same? Let us use the same scenario. So already, Dr. Murli has 50 lakhs, in savings, and if he takes a 50 lakhs loan and pays the EMI for 20 years on one side, and on the in other table, no, as you said, he'll be paying 50 lakhs additional as interest. So he'll be paying a total of 1 crore for 20 years as EMI. On the other side, since he already has 50 lakhs as saving, if he doesn't touch it and he allows it to grow, compound, even you take less than interest, say 10% or something, and calculate the amount for 20 years, what this 50 lakhs saving would have grown to. Can you do that?
Yes, sir. So you will get another 90. Wait, sir.
Yeah. But thing is, all this is theory. Something
Sir,
like
this is a
your.
theory. Yeah, it will give you some theoretically. Okay, but the point is, I see.
Yeah.
I have another one. Okay, so if he has a loan, if he has a 50 lakhs, then what I can show that is called SWP. SWP means systematic withdrawal plan. So what it will do is we have to take a amount. Okay, monthly EMI from that investment. So the growth is also happen, and you will, for example, I don't know whether I can get it. That is called SWP calculator. Okay. SWP calculator. Okay. So I think this is a SWP calculator. Okay. Systematic withdrawal. Okay. So total investment is 50 lakhs, right? So it is 50 lakhs. Okay. I'm considering about the home loan only. Okay. So that you will understand.
Yeah.
Okay. So I have a 50 lakhs now. Okay. Monthly withdrawal is I'm taking 40,000. Okay. I'm taking 40,000. Okay. 40,500 something. and my expected return is 12%. Okay, I'm putting averagely 12%. Okay, now I'm taking a home loan for 25 years or even 30 years. The maximum year I'm doing, okay, 30 years. Then you can see the, sorry. Yeah, again it is changing, sorry. Uh, okay, so here we have 40,000. See, 40,000 is a EMI, monthly EMI. Okay, so I'm taking a monthly EMI from that investment. So here the expectation of growth is 12. Okay, so I put like a 12 averagely. Okay, and the home loan always maximum 20, 25. I put 30 years. Okay, so if you put 30 year, you see the thing is total investment is this. Okay, but amount of withdrawal you see. Okay, and also you can wait. Oh, sorry, 40,000 la 40,000. 40,000. So this is 40,000. Okay. Now you see, after 25 years, see, after, for example, I'm taking a home loan. Okay. I have a 50 lakhs. I'm putting into some mutual fund. Okay. From the mutual fund, I'm taking SWP monthly 40,000. Okay. I put a return of 12%. Okay. After 12%, 25 years, you see 50 lakhs I invested. I withdrawal 1 crore 20 lakhs. Okay. Even though I have a 1 crore 6 lakhs, 1 crore 60 lakhs, it is in my account. Okay, because of the compounding effect. That is what I am telling. Okay, so this is, if you have a money, okay, you can instead of paying full amount, you can do it, because anyway what the 20% you will pay in advance. From all other, you let it be in the mutual fund or some investment instrument, any instrument. Okay, and you have to constantly take as SWP. Then you will pay the interest simultaneously. Then the investment also will not be stopped, and also you will also get a good amount in there also. So you will get the property also, you will get the amount also. This is also one of the way, rather than doing, because 50 lakhs, if it is for 20 years, 30 years, no one will keep. Okay, they definitely, they as a businessman, they will try to use to build more instead of keep on for 20 years. They will try to invest something and to get more percentage. Okay, so that is why. So this is also one of the way to do it.
Yeah, got it, got it. That's the thing,
Yeah,
yeah. In a
Dr.
businessman,
Murli,
everybody
if
thinks,
you have
yeah,
already done this, there's nothing can be done. But in
yeah,
future, do not
yeah,
mix the two. Investment
yes, sir.
grows exponentially, whereas the loan, it's a reducing balance.
Yes, sir, yes, sir. True, very true, very true. Thank you so much, Sayamappa.
No,
Thank you so much.
you interrupted the compounding effect of
Yeah,
your savings and investments.
exactly, true.
Yeah, Prasad sir, Vila sir, can you tell on this how your experience about the investment, and uh, can you please share, sir?
See, basically, it
Yeah,
all depends on your active income. Uh, Having a cash backup in case of emergency where your active income is not working, you have always a cash pot in case of emergency. But compounding and having a liquidity is always giving a peace of mind. Although there is a loan of 1 crore, but your investment is also there. So it's a approach of a liquidity, and as Prasad sir rightly said, that it's reducing balance and compounding. So it's like a one way, loans principal is increasing, interest is reducing. Here
yeah,
your returns are increasing over a period of time. So actually, you have to keep the money as an investment with the objective. Like for your retirement, you have to have a certain cash which is in your control and whichever business, because you are in a profession of medicine, so you are more confident because you have more knowledge about that. So your whole thing is there. But again, it's one sector, medical and health. So there is no
Yeah.
guarantee also that how the hospital will work, how much competition will come, more
Yes.
hospitals, more clinics. The
Yeah.
AI is also
Yeah.
coming in the area in the operations and all. So the
Yes. Yes.
machinery will take part. So each and every segment is also having another risk. So it's a
Yes.
normal human tendency to get rid of the loan
Yeah.
because this is the upbringing we have that we
Yes.
should not have a loan, you know. But that's where we have to, it's all about mindset. Like carrying a loan but keeping the within our means, not it's overblaming, you know. It will not disturb your peace of mind. Whenever you
That-
want, you have other assets to uh, get rid of it. But your other liquid asset has to keep on growing and multiplying, which will give much more returns vis-a-vis your interest. So that's where you can win the race over a period of time. And a longer period means it's not initial 5 years, 10 years. After 10 years, after 8 years, actual compounding happens. 8 years,
Yeah.
12 years, yeah, 16 years, 18 years, 20 years. So that requires lots of patience and discipline and objective.
Yes, sir. That's great. Thank you so much, sir. That's the one thing. Second thing, what I think is, see, in young age, if you start saving and all those things, in old age, that will give us the returns. And old age money will go to our children or grandchildren. We may not be enjoying that money. So sometimes I feel that we are. It's our Indian basic mindset that we start saving everything for our children or grandchildren. We don't enjoy our life. We don't go to foreign trip or we don't do things like that. So that one kind of mindset is within us. How to tackle that, sir? Please.
Yeah, that's where the SWP comes into picture. Your capital is also there and your withdrawals are also there. So
Yeah.
there is always a one factor like inflation. So
Mm.
tomorrow you say, see, one thing we don't know how long we are going to live, and
Yes.
second thing we don't know how much inflation it will be there because of geopolitical situation, oil prices and
Yes.
all. So
Yes.
to make a balance, we have to keep on invested and we are keep on withdrawing. So we can, you know, adjust our withdrawals as per our requirement. But the
Yeah.
main part is that we should be in the market.
Mm. So very true, sir. Thank you so much. Yeah.
Yeah.
Should balance it. Yeah.
Yeah,
Thank you so
one
much.
point I would like to add, Dr. Murli,
Yes, sir.
is even though people are wealthy, have a lot of savings, this is where the mindset comes. Even Ivan sir mentioned about the abundance mindset.
Yeah.
They can afford a lot of things. As you said, the mindset is whether we would like to enjoy now or keep it for the future generations to enjoy. So again, it is all our mindset. So things
Yeah.
have changed a lot after COVID. The savings mentality has come down. People are spending more. They are traveling. They are going on,
Yes.
foreign
Yes.
tours and other things. And as
Yeah.
you can see, even spending on vehicles and real estate also has increased. So
Yes.
again, it is the question of mindset and uh, being rich is one thing, but are we really uh, getting the dividends of the abundance that we are having? Are we really
Yeah.
enjoying the question
Yeah.
that we need to
Yes.
ask
Yes.
ourselves? Yeah.
Yeah. So we should simultaneously enjoy it, sir. Then it's worth having it. Yeah. Start simultaneously enjoying your life also, so that whatever the hard-earned money is there, wealth is there, richness is there, until unless we enjoy it, just keeping for our generations or for the old age, there's no point. We should enjoy simultaneously and save it for our generation as far as old age. Then there's a meaning in that. Thank you, sir. Thank you so much.
Yeah, that's the point which Vilas sir mentioned. We need
Yes,
to
sir.
have a clear intent or an objective why we are earning money, or why we are saving money, or why we are investing money. So without that objective, even though we have that abundance, we may not be enjoying our life. Again,
Yes.
enjoyment varies from person to person. Again, the value system is different. Again, there are many factors, upbringing, and all those things. So there was, I think I shared this earlier. Shah Rukh Khan, in one of the interviews, was asked, why does he's already rich, and even for several generations to come, even if he stops working, he has so much of money. So what he said was, what he experienced in his childhood. He lost his father early, when he was young, and again mother also passed away soon. So what he experienced during that time, he doesn't want to experience again. So that's what makes him get out of his bed and go to work, in the movies. So there are many psychological this thing. So please read this book, The Psychology of Money, and probably that will throw some light, Dr. Murali.
Yes, sir. Thank you so much. Yeah, I already brought down the summary and went to it. And what I do is, whenever such books are discussed, I just go to my A and withdraw 10 certain points which is applied from my life and my economic state along with I'll ask my ChatGPT. Give me some really, really very good inputs. I'm trying to put it into my practice also. Done, sir. Thank you so much.
Thank you.
What everybody can do is, sir, in ChatGPT, it has my history. I've already prompted it. So whatever I ask, it knows what is my financial status. It knows what is my cycle status, and accordingly, it will give salient points and features which even I wouldn't have thought of. So that's the
Yeah,
best part of
but
ChatGPT.
please be careful. ChatGPT is an open source. Do not give too much of your personal information. It can have other impacts also. There are many people who will be who will be there to exploit such information sharing. So be careful about it.
Yeah,
Thank you,
one
sir.
thing I
Thank you.
want to tell you, sir, like, latest it has happened. I think US, they bought the chat GPT or something like that to use the personal information to the government. Okay. But the Claude, they refuse to do it. It is, I can't do, and they refuse the agreement. I think the chat GPT owner, he accepted the agreement, and he ready to share his personal information, whatever there for the US government. So there is always, sir said, okay, ChatGPT, we can use it for to enhance our thing, but we should not do full personal information. So it is not good for thing, because we don't know what government will do with that information. If they misuse, and they will, and we will be the product for the next year, like that. Okay, sir. Thank you.
That's it. Thank you. Yeah. Got it. Thank you so much. Yeah.
So thank you, everyone. Thank you, Dr. Murali. Thank you, Pandya, for a fantastic session. Thank you, Akila ma'am. Thank you, Epan sir. Thank you, Naveen. Thank you, Pramod. Thank you, Prasad. Thank you, Soja ma'am. Thank you, Veerapan sir. Thank you, Vila sir. Thank you for your valuable inputs. And let us join
Thank you
again
very
tomorrow.
much.
Thank you.
Yeah. Thank you so much. Thank you.
Thank you very much, Pandya. Thank you, Prasad sir. It's a great learning today. I'm doing some work on listening everything. Yeah, thank you.
Thank you all. Thank you. Bye-bye. Have a great Sunday. Bye-bye.
Okay, thank you all the participants. Have a nice day. Thank you, Pandian. Okay, all the best. Yeah, I think we can have another session also for question and answer.